there will be a short video on GOPAL World Forum of Accountants.
Arthashastram, Dharmashastram cha, meaning economic principles, Arth, and ethical considerations, Dharma, which are central to the work of accountants. The entire world is deliberating about the impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the world, where accountability means innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GOPAL, proudly presents before the world World Forum of Accountants 2025. Accountability means innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashogumi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashogumi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability means innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashogumi, New Delhi. For more details, visit wofa.icai.org.
Once again, I welcome you all on a Diwali evening, taking the time to attend the session. Thank each one of you. Now, let me introduce the speaker. We have an expert speaker for the day. Mr. KRISHNA RAJU is a practicing chartered accountant. He is also a registered insolvency professional and a registered valuer. He is a partner of GOPAL and Co. He also has a doctorate in governance of GST. And if I go through his qualifications like Oxford Dictionary, there are a lot. I'll read a few. He is also a member of Institute of Chartered Cost Accountants of India and Company Secretaries of India. Besides, he has done MPhil and other courses. He has also authored 3 books, Standard Costing and Variance, and he has authored books on information technology. Besides income tax, he also speaks on information technology, and he is a visiting guest for numerous other institutions. With this introduction, I pass over to Mr. K.R. Welcome, sir. Thank you.
I now request Mr. C. A. Ramachandran to present a small memo to our speaker. Stool
Good evening, friends.
Good evening, sir.
So at the outset, let me thank SIRC for this wonderful opportunity to be part of Diwali Week. I never expected even a single member for two reasons. One is Deepavali, second is Varna Bhagavan's excellent sudden outburst. I am sure that we all have assembled here not for the faculty but for the topic. Given an opportunity to me, I also want to visit my side and want to listen to this topic on taxation of financial instruments, which is a very big subject and it's a sub-subject under income tax act. I understood that it is every type of instrument. We only know about short-term calculation, long-term calculation, computation. But as we well into the subject, the type of provisions with respect to each kind of instrument is different. To give an example, recent budget, that is Finance Act number 2 of 2024, they brought a chain of amendment with respect to one instrument. That is with respect to buyback of shares. Just one instrument. So it's such a interesting subject. So I try to make it as simple as possible. So with the support of each and everyone. Let me give you a background with respect to the current provisions. So generally, when we do computation for with respect to financial instruments, let us take an example. Equity shares. Let us take an example of a mutual fund. We have a specific provision and over a period of time, they have identified separate provision because of the concessional tax rates. So, especially 111A, 112, 112A, these were not there previously. So, over a period of time, it has this subject has matured. Current year, especially on 23rd of July 2020, when the Finance Act number 2 2024 was, the bill was introduced, the subject became a little more, maybe in the term of the provisions of law, we may feel it a little elongated or complicated. But in terms of tax rate, they have done simplification and rationalization. These are the two words Madam FM has used in her speech 3 times. Okay, in the budget speech, we have done rationalization, we have done simplification, we have done rationalization, we have done simplification. Okay, so let me go into the subject and find out what is the very simplification that has been done. So one interesting aspect is with respect to long-term capital gain, short-term capital gain, there is some sea change. Maybe whatever I am going to discuss, even though my presentation will be focused towards financial instruments, I will be making it generic. It will also be applicable to other assets also. This year will be very unique, especially financial year 24-25. For what reason? The reason is we have to remember the old level as well as the new level. The old provisions of law is applicable up to 22nd of July 2024. And from 23rd of July and onwards, new provision is applicable. So meaning, if I have 500 equity shares, I sell out of 500 equity shares, 200 I sell in before, that is from 1st April 2024 to 22nd of July 2024. The computation will be with respect to the S2I provision. And maybe out of the remaining 300 shares, I keep up 200 in stock and 100 I sell. Maybe today I sell. Diwali Muhurat, when it is opening, I sell on that particular day. So then, both are long term, but the computation is different, which was not the situation in the previous year. That is for up to financial year 23-24, it was different. So we only will take the selling price minus the cost price, selling price minus cost price in whatever is taxation. So this year is going to be unique. And again, whether the concept of indexation will apply, all those also we will try to explore. So the first, in the name of simplification, what has been simplified is rate has been brought down. So that is one simplification. So where so this is I will take one by one so that this is one thing I just want to share it with you so it is visible. Yes. Okay. So whatever I just now mentioned, I have just captured in a nutshell, and then I go into the subject one by one. So the date of transfer before 23rd July or after 22nd July. So that means you have to read it as 23rd and above. Okay? On or after 23rd July. I have written it. And this is one cap. So when is the date of transfer? This is the first. So whomsoever is walking in as a client for the maybe once the March is over. Okay. So whatever the method at which we are doing the computation earlier, this year a little more care and caution. So this is the first thing. Okay. Now if it is everything is done through a portfolio management or through we will have at the back end some data will be there. So the person is managing himself also. It is required that he puts out that particular data and he gives the respective input properly so that the computation is easy. And please look at the second part. Whether the acquisition is before 1st April 2001. Actually, this is not much relevant as far as financial instruments is concerned. Because in financial instruments, the concept of grandfathering happens. This grandfathering concept, of course, this is also a grandfathering view, technically. If it is a immovable property, any cost, maybe if the acquisition is 1990, 1995, okay, and acquisition is at 10 lakhs, and the fair market value, actually, this fair market value is as of 1st April 2001, as far as the immovable property is concerned, it is only treated as a stamp duty value. So, if the stamp duty value is say 18 lakhs and your cost is 10 lakhs, so up to 18 lakhs is grandfathered. So that is so this concept of grandfathering is also there. The other than financial instruments also. And if acquisition happens between 2001 and 22nd July 2004, 2024. Now, I want to make one observation. Now, why this is significant? Of course, for the current year, this may not be significant because any acquisition done after 22nd of July 2024, I repeat again, any acquisition done after 22nd of July 2024, that is from 23 July 2024 onwards, even if it is a long-term sector, the concept of indexation is gone. Okay, the concept of indexation is gone, except for one exception. So that exception I will mention that also. So if any acquisition is done post 22nd July 2024, okay, it is very clear it is there is no indexation applicable. So even if it is a long term, but as far as the financial year 24-25 is concerned, we may not come across that situation. We will only come across that situation from next year on, that is from 25-26 financial year. But as far as any asset that is acquired, a financial instrument acquired, maybe in July 24 or August 24, and maybe transferred in December or January 2025, it will be short term only. And maybe if I acquire in October 2024 and I transfer it in December 2025, it becomes a long term. Now, whether I am eligible for an indexation, no, the provision is not applicable. So, I am a little ahead with respect to that indexation concept. But as far as the current year is concerned, so any acquisition post 22nd July, so no. Therefore, this year is a very special year, a transition year, a learning year. So, quite a number of sessions like this with many case studies. I don't know whether I will have that much time to share with you multiple scenarios. I have taken out at least 2 dozen plus scenarios, okay, for different types of asset. So where the applicabilities are different. So I have tried to present you the provisions, and then maybe we should have more sessions exclusively on this with respect to various scenario analysis. Okay. So especially I come across when should I have to average it, should I have to be very specific. So many aspects will come. I will try to explain that with some examples. So this is one care and caution to start. So let me now take you to this provision. I will because this is one type of asset, one type of financial asset where they have totally changed the what is before, what will be after. And this change is applicable with respect to buyback of shares from 1st October 2024. Okay. So how things have, it actually started very simple. Okay. There were a lot of provisions. There are certain rules were also there. There is one particular rule called Rule 40BB. How to actually arrive at the cost for a buyback. I'll give you the situation up to 30th of September 2024. From 1st October 2024, situation is different. What is the situation? What is buyback of shares technically? Company itself will buy its own shares. That is buyback of shares. We have the provision under the Companies Act 2013, a section called 68. So it gives the prescription. There should be reserves, ityadi. You cannot buy back more than 25%. Those are Companies Act provision. So that I have to anyhow satisfy fundamentally. Come to the taxation part. From the issuer perspective and also from the shareholder perspective. I take from an unlisted company's perspective. The listed company perspective is very, actually very simple. And we have a separate prescription under SEBI regulations also. And same provisions is also applicable for a listed company. Now, what is buyback of shares provision and prescription? Because this is 1 year, we need to remember both. So both the old provision and the new. So if buyback happens before 1st October, old provision will apply. And after 30th of September, new provision will apply. Now what is it? Yeah, face value 10 rupees share. The book value is actually 25 rupees. Okay, book value is asset minus all liabilities. Share capital plus net worth is 25 rupees. Face value is 10 rupees. But I am buying back the share at let us say 70 rupees. 70 rupees. So now there is a concept called distribution. Distribution of income to shareholders. Okay, so this under this particular concept, what is called distributed income? So technically, accumulated profits you can give it as a dividend, or you buy back the shares and surplus you are distributing. So that is when this term called as distributed income. So the obligation of taxation was on the company. Now who is distributing? Issuer is distributing. Company is distributing. Okay, so let us take an example. A 10 rupee share, book value 25, 70 rupees. So I am buying back 70 lakhs worth. In fact, multiple for the same number of shares. So 10,000 1 lakh shares. So this 70 lakhs I am actually paying. Now what is the cost of this? That is where rule number 40BB says what is the money that has been paid by the company at the time of issue of the shares. So let us presume that it is at the par. So then 70 minus 10 will be the distributed income. So the entire 70 lakhs is not income. So this distributed income is a calculation. You can see that they define what is the distributed income. So that 60 rupees, on that 60 rupees, there is a tax rate of 20% plus the cess and the surcharge. All this will be added. And who has to pay? Company has to pay. And we have a section called 1034 which was exempting in the hands of the shareholder. So this was the provision. Now, generally in a private limited company, unless and otherwise, the shareholders are all family members. Okay. Then this will apply. Okay, I will not pay tax. Let the company pay tax. So this will work out. Now, if I have some shareholder who is an outsider and I want to kick him off, so then will this concept of paying taxes by the company work out? It will not. He is going to make profit, why I should suffer? So this provision was not generally, unless and otherwise it is a family owned and they are doing some family structuring. Okay, we have some companies, brother one, you take one, brother two, you take one. So then this provision will work out practically. If there are outsiders, company will say, no, you find out any other alternative. So generally when we give opinions on this buyback, it depends upon the type of shareholder. So if it is a family, even the family members, if it is there, again they will come back for a second round of discussion, they will say, no, it is our own company, our own shares, and we are distributing ourselves, why should we pay tax to government? So there also, we cannot convince the deal will not work out. So this provision technically is an exam provision. We can test the knowledge of the CA final students or whatever it is, but it was not a practically implementable. So in 99% cases, it will go up to the table of the board, and the board will ask for argument. Okay. So now they understood that this is not a taking off provision. So why it is not taking off also they know. Now the only solution is, okay, now who is benefited? Shareholders. Now we will tax it. Simple. But that is a very interesting point. Now this buyback of shares, so 70 rupees minus 10 rupees, 60 rupees. Taxable in whose hands? In the hands of the shareholder. So they brought a provision for TDS also. So now instead of 20%, it will be 10% TDS. But for non-residents, 20%. Okay. So this is one. And this exemption to 1034 is there. They removed it from first time. So this is not applicable. Now, very important. Very important. This will be taxed under capital gains. Now, technically, when you sell a share, it's actually buyback. You are a shareholder. I am a company. I buy your share. So when you transfer, it should be actually a capital gain, but it is not capital gain. Okay. So actually, my surplus profit will end. Buyback is one. Why buyback? I don't want to give dividend. So instead of dividend, I buy back shares, and I concentrate my number of equity shares. When I concentrate my number of equity shares, my earnings per share will go up, my valuation goes up. All these benefits are. So then it is not capital gains. You are only distributing profit. So therefore, I will bring a new definition, and that 222 dividend. So this is not dividend. Appo share transfer பண்றீங்களே, then what will happen to that? So you bought the shares at 10 lakhs. Now I am buying at 70 lakhs. So you are getting the difference of 60. Now what they say? Whatever I am giving it to you, what I am giving you subscribe me 10 lakhs. I am now paying you 70 lakhs. Entire 70 lakhs is dividend. Look at this. Any payment by a company, not deduction. You are not 10 lakh shares I am giving. 10 lakhs will become capital loss. Okay, because the shares you are transferring, what is the consideration for that? 0. Look at 46A. Provided where the shareholder receives any consideration of the nature of 222F, then any company, in respect of any buyback of shares, that takes place on or after 1st October, then for the purpose of this section, the value of consideration received by the shareholder, how much you received? 0. So, sale consideration 0, cost 10 lakhs, then difference? 100 lakhs. Solve out or not? dividend income 70 lakhs. I have a long-term capital loss 10 lakhs. Now you have to tell me set off and carry forward. And next to another gap. Okay. Normal provision. So that means if the transaction happens 1 day before 1st October, situation different. From 1st October, situation is different. Now can I subtract this 10 lakhs from, because dividend income comes under income from other sources, plus 70 lakhs. My capital gain is a loss, and that too long-term capital loss. Now long-term capital loss, short-term capital loss I can offset with the long-term capital gain and short-term capital gain. Long-term capital loss I can offset only with the long-term capital.
Long-term capital gain is 10%. For dividend, we have to count it at 30%. So that you come from
government, but here again, one thing will be very clear. Okay, you are giving anything to shareholder, let him pay tax. Okay, and that is why they have brought one more tedious provision for, and they cannot say, no, I will keep my transaction myself, let the government ask. So that is why the obligation is also put on the company to deduct 10%, and he will file that to the government that the balance you recover from that particular person. So the transaction has now become very clear. So whenever it is a transaction, is an outsider transaction, okay, the shareholders are not related parties, it will happen. But when they compare that with the previous provision, actually the equivalent tax would have been some 22.36 or some 23% maximum. But now, this dividend, of course, the 23% will be on the 70 minus 10 lakhs. 60 lakhs now. But here, on the entire 70 lakhs, it will be 30%. Maybe if he is above 15 lakhs, means 30%. So it's quite very interesting provision that has been brought. So many changes there. So there's only one provision I have explained. Okay, one instrument. Okay, buyback options.
Similar for listed companies also.
Because that is why I want to mention. From any company. From any company. Another thing I might distinguish. As far as the compliances part and the Companies Act and the SEBI compliance only, you have different prescriptions, because SEBI regulation gives a separate prescription for buyback, and as far as buyback, you have 68 and the related rules for it. That is for unlisted. But 95% of the prescriptions are under the rules, share capital and revenue rules, the SEBI regulation for buyback will be almost the same, 95%. So this is with respect to this. So TDS is also. Now I am taking you to yeah. This is the change that has been done in under 11A. Short-term gains. Now what is this 111A? Okay. This 111A is a special section. Special tax. Concessional tax. Okay. I have to make one observation here. Before I go into that change law, because I am not showing you the entire section, only the change law I am showing. This section is applicable to everyone, okay, including non-residents, residents, company, individual, actual, whomsoever. Okay. I've just given you the snapshot. And applicable for equity shares, equity oriented fund, and this is an equity oriented fund. Okay. So where actually there is one more concept called fund of funds, where such a fund will only invest in they will only invest in an equity oriented fund. So please look at this fund of fund. So a minimum of 90% of the total proceeds of such a fund is invested in the units of such other fund. Okay. So this is one thing I want to make. So when fund invests in the units of another fund, then 90%. And if an individual is investing, then it is 65%. 65% then equity, the balance can be done. So this is one thing we will keep it in mind. That is only for mutual funds. Now, when I bring to your attention the mutual funds, equity oriented funds, then other than equity oriented funds, we also now have a very special category between these equity oriented funds and other than equity oriented funds called specified mutual funds. Okay. So I may take some time in this, but first I will give you a generic understanding. Okay, a general understanding, then I will go for a specific masala additions. So this is for equity shares, for mutual funds, and also for business trust units. Okay. And most importantly, it is what is the change they have brought? This is the only change they have brought. 111 capital A, they have not made any change except for reduction of taxes. Okay. Now, I will give you a background for this, then I will go into some specifics where you are challenged. Okay. So, please don't have a feel that, oh, section, a lot of changes have happened. So many things will change. Nothing. No change except for two aspects. Okay. So whatever the short-term capital gain computation we used to do till last year, that is applicable even. Okay. For example, you bought a share in the month of January 2024. Okay, 100 shares at 500 rupees. And in October today, the same 100 shares, which is the same 100 shares which is bought at 500 rupees, you are selling at say 550 rupees. Today you are selling, so which is less than 12 months. Okay, and 50 rupees is your gain on 100 shares, so 5,000 is your gain. Now, when did you sell this? I have sold it on 29th of October 2024. If I have sold it on 29th of October 2024, the tax rate is 15%. Now, instead of selling it on 29th of October 2024, I have sold it on 29th of June 2024. So then, the tax rate is not 15%, it is 20%. So this is what I was referring at the beginning. So hence, this particular year alone, the date of transfer is very, very important. And already, those who are having account with ICICI Direct, that is PMS services, everyone they at the back end, they have already changed their systems in such a way that the year-end reports. So what you were doing till last year with respect to computation of capital gains, same. This year, the table will now become two. Okay. One table with respect to the transfer took place up to 22nd of July. From 23rd of July later, what is it? So short-term transfer up to 22nd. Short-term transfer after 22nd of July. Long-term transfer up to 22nd of July. Long-term transfer after 22nd. So, instead of doing 2 computation, now I will be doing 4 computation. So, this is the thing we have to be careful.
What is the significance of retard actually? We have waited for 1 more week and make it 1st of August. Very easy to remember. This happens in almost all the amendments, but nevertheless.
Okay. We have to ask this question to Madam.
It's just not this 23rd. Any amendment for that matter. It happens on 18th of 1 month, 13th of the other.
We chartered accountants are a very special breed. So whatever amendment they will bring,
This gives us a kind of pleasure also, because if the law becomes very easy, then everybody will talk about it.
Yeah.
It will not come to us. But that part, please, collectively, that wisdom into their mind. Please go.
It all depends upon how North Block works. When the madam's time is available, all these are various combinations. Actually, these amendments are already drafted. Okay, already drafted by the budget department. They have been working for quite around the year. So they have everything. Only they will be asking the date when it should be officially announced. Therefore,
Madam would probably say, do it.
so, right now, only one aspect I want to clarify here. That Madam was referring to the word called simplification and rationalization. So I will come for that. Now, where rationalization happened, where simplification happened. Actually, this provision was beneficial, okay, to many, especially who were. I want to tell you something about one SEBI report. Then this logic will be. Now, what is that SEBI report? Last year, that was 23-24 financial year. Okay. People who lost money in stock market. Okay. What is the total money that has been lost? It is close to 1,90,000 crores. 190 followed by 30 after that crores. So how many crores, how many zeros we have to find out. Now 1,80,000 crores is lost by individuals. On an average, how much money is lost? Per person, on an average, 2 lakhs. They gave one more very interesting statistics. What are the statistics? That married men, they either don't lose money in stock market or their loss is very less compared to unmarried men. Okay. This was the report. You got to read the books. SEBI gave a lot of points. One of the points is this. Then somebody like me researched on it and said that okay, because married men, they don't have futures and they don't have any other options in their life. So therefore, married men don't make loss in futures and options. Okay, so this is one side apart. Now, those who are making profit, they are making, this is 92% of the population who are doing trading in the stock market. About 8% of the people are making profits. And what is the profit? Huge profits. Technically, short-term gain should have been charged at what rate? Should have been charged at what rate? 30%. Now look at the prescription here. Transaction is charged to security transaction tax. That means you should have sold it through
stock exchange, recognized stock exchange. Now, if you have sold it to recognized stock exchange, if it is a normal unlisted company shares, you will pay 30%. But now you are only paying 20%. So 10% loss on a very big chunk of money. Okay. So that is why, 15% was the rate, not 20%. 15% was the rate, which is half of 10%. So they increase it to 20%. So that is why, and they were very clear that please look at the stock market till 23rd of July. Please look at the stock market trend after 23rd of July. And that too, past 15 days or 1 month, you see the trend. Actually, the market is doing self-correction. Okay, self-correction. They may say some thousands of crores loss. Because loss means technically prices are falling. So I may hold it. My price was in July 550, now it is 450. That means 550 also I have not sold, 450 also I have not sold. Technically I have lost many hundred. So that is the quantum they are actually making. Meaning the market is correcting itself. And there is a buoyancy it has been brought. This is one very, very important change they have brought to bring buoyancy. Okay, short term, 15%, 20%.
Kind of increasing the investor mindset to retain for a longer period.
Exactly. So this is one logic there. So maybe concessional tax rate was brought. This section is there for the past 12 years and above. Okay. Now the trend of market. If you look at the stock market, from the day 111A was introduced, the market or the trading swing is more. Okay, the short-term trading is more. So that is also, so this section has a lot of direct nexus connected to the stock. So this has a very, very important trend setup. Now I have some very challenging questions. Okay, now what is that? Solid the question I get. Okay. The question first let me put it, then I will come to one more interesting question. 111 days here. I'll take you to 112. Okay. Good. Now here, please look at this. 112 and 112. This is only the change alone I am showing because all other things are same. I am not showing the entire section. Only the change alone I am showing. Now 111A is more. 112A. Now with respect to 112A and 111A, is there any difference? What difference is there? Okay. What is the difference? Please look at the top in blue color. Notwithstanding anything contained in section 112. That means 112A is a standalone section. Very tiny. Whatever has been mentioned in 112, not applicable. This is standalone. In the provision, equity share if it is long term, equity mutual fund if it is long term, business trust unit long term, 112A is only applicable. So whatever is mentioned, because 112 it was a generic section. Okay, so that is why they started with non-mixing. Now, I will now take you to the main change. This is the rate is concerned, I will take you to 112 and tell you what is the tax rate. So, this, in case of an individual or an HUF, the amount of income tax payable on the total income, okay, will be, this is the two rates. Now, with respect to 111A, there is an increase in tax rate, and they call it as rationalization, because they don't want minority people in the stock market to make money to exploit and majority to lose money. That is one rationalization. Inga, what is rationalization? They want this long-term capital gains tax rate was 20%. Now they are reducing it to 12%. So previously it was out of 5 rupee gain, 1 rupee belongs to me, 4 rupees belongs to me. So 80% is yours. Now 87.5% is yours, 12.5%. So out of 8 rupee, 1 rupee is mine, 7 rupees is yours. So this is the main change there. But again there is a problem here. So in case my equity shares, my mutual fund is long term, and I sell before 23rd of July, my computation will be at 20%. Post 23rd July or above, my computation will be 12.5%. But here there is one catch. Okay, what is the catch? So from 20% they reduce to 12.5%. So does it look favorable? Yes. There is one more favoritism they have brought. What is the favoritism? Is this 112A to 1, they have replaced it by this. Because previously it was 1 lakh, now they have increased it to 1,25,000. Now what is the significance of this? Aram karo stock market. Invest, equal, 1 year later sell. In your family, how many people are there? 4. Open 4 demat account. Each one of you, 1.25 no tax. 4 persons, 5 lakhs no tax. Per person, 7 lakhs no tax. 7 into 4, 28 lakhs no tax. 28 plus 5, 33 lakhs there is no tax. That means, don't exit stock market within 1 year. One thing, I'll penalize you by more 5%. You wait for 1 year, I'm giving you more exemption. Okay. Tax rate is also this. It will look lucrative, but simplification and rationalization. So normally accounting entry means for credit there should be a debit, and that debit is no indexation. So the new syllabus CA students, those who will be joining foundation this year, doing the intermediate for next year, for them, no indexation chapter will be there. Because any asset you buy after 23rd of July is going to be, even though long term tax rate is different. But the computation for that sale consideration minus cost, sale consideration minus cost, the concept of indexation indexed cost acquisition, indexed cost improvement, that indexation done. But we need to understand one thing. Asset acquired before 23rd of July and sold after 23rd of July. Indexation available. Asset acquired 23rd of July and above, sold after 23rd of July, no indexation. In the clarity. Therefore, indexation of the syllabus so if there are previously 10 questions, 8 questions with indexation, 2 without indexation. Now 8 questions, 9 questions without indexation, one last question in case the asset was long purchased and sold now. Okay. That's the only thing. But I want to make one observation. Only one observation. Okay. Please look at this. Please. It's very important. Okay. Actually, I'm only giving you the change alone in 112 only. Only the change, not many things. The proviso was two proviso is there. Originally, when the finance bill was introduced on 23rd of July 2024, only the first proviso was there. But when the Act came, okay, in August only Act came, Finance Act number 2 of 2024 Act came. It was signed by the President. When the accent was given, the second proviso was it. Now I want your complete attention. Okay. Why? Because there is something I put in practical. Provided further, now I want your attention for first provision, second provision. The 112(1)(a) is a tax rate for individual and HUF. Tax rate has been reduced to 12.5. Now, do they speak anything about movable and immovable? No. What they say, the amount income tax payable on total income has reduced by the amount income tax calculated on such long-term capital gain. That's all. They don't distinguish whether it is a financial asset or as an immovable. But here, come to the proviso. Provided that where the total income has reduced by the NTCG is below the maximum amount which is not chargeable to, then such NTCGs have been reduced by the amount by which the total income so reduced falls short of the maximum amount which is not chargeable. That means you are eligible for that. That is basic exemption. Okay, so that is what they mentioned. Come to the second proviso. Provided further. But in the case of transfer of a long-term capital asset, in land or building or financial instrument, very careful. Now, I have a long-term equity share. Okay. I bought it for 10 rupees. Bonus, excited. Accumulate. 1:12. Today, that 1,000 rupees, 1,000 number of shares has now become 50,000 shares. And my original cost was, total cost was only maximum 1 lakh only I paid. Today I am selling that entire 50,000 shares for 8 crores. Okay. Now, am I eligible for indexation? Actually, if it is a landed building, there was a lot of representation here. What is this? In case I would have put up my indexation, and even after indexation, I paid 20% higher. My tax is lesser than 12.5% without indexation. So this is not fair, this is not fair. There were a lot of representation from the individuals, press, Instagram, Facebook, then to cool down this second proviso was introduced. But second proviso introduced one more. Okay. providing further that in the case of the long-term capital gain land and building, so I am providing further any long-term capital asset acquired before 23rd, even for financial instrument it is applicable. So therefore it should be very clear. Once a financial instrument means long-term gains, 23rd July crossed means 23rd July crossed means indexation credit. 12.5 apply பண்ணாலே indexation credit. 20% இருக்குன்னா indexation. When 20%? Up to 22nd of July. Simple. Now I am coming for another complication. It is very common. Subject is interesting. Okay. Now, why I said I think maximum another 15 minutes, then I will have some question and answer. I am coming for another challenge here. One of the important challenges. Another challenge. Okay. They say you have an exemption of 1,25,000. Okay. The amount of income tax calculated on such long-term capital gain exceeding 1,25,000 on long-term capital gain at the rate of 10% for any transfer which takes place before 23rd of July. Normally, this special tax, concession tax. So, it is not 20%, it is 10%. So now, that is also rationalized. That means technically there is no difference between 112 and 112. 112 also 12.5%. 112 also 12.5%. 112 you have an exemption of 1,25,000. Here I am going to add one more. Provided that the limit of 1,25,000 shall apply on aggregate of the long-term capital gains under subclass A and B. A and B. Because you have a long-term capital gain, let us say 1 lakh. You have a long-term capital gain of 1 lakh up to 20,000. You have a long-term capital gain of another maybe 50,000 in the second half. First half 1 lakh, second half 50,000. Okay. If for the 1,25,000, okay, I can even put it like this. So you have 1.5 lakhs profit in first half, 1.5 lakhs profit in second half. Okay, 1.5 profit in first half, 1.5 lakh capital gain in second half. If this 1.5 lakhs surplus in first half is taxed at 10%. 1.5 lakh surplus in second half is taxed at 12.5%. Tax rate has to second half 1,25,000 inga credit first la credit second credit. I was searching for answer for this. I want some very interesting answers. Well, this is one answer I can find out anywhere. Usually, provided the limit of 1,25,000 shall apply an aggregate of long-term capital gains under subclass A. இது சொன்னா எனக்கு என்ன சொல்லுவாங்க சார், எங்க டாக்ஸ் ரேட் ஜாஸ்தியா இருக்கும் அங்க மைனஸ் பண்ணிக்கும் இப்போ நீங்க சொல்லுங்க. இதுல ஒரு இன்ட்ரெஸ்டிங் பார்ட் இருக்கு. Because up to 22nd of July, I know the exemption is 1 lakh. Section is already there. On 23rd of July only, the exemption became 1,25,000. அந்த அனாமலியை ரிமூவ் பண்ணிட்டு இந்த ப்ரொவைஸ் ரெண்டுத்துக்கு சேர்த்து தான் 1,25,000. It is not 1 lakh upon extra 25 அப்படின்னா. But this challenge will be there. I believe that some circular can come, and that circular will be this exemption has to be applied on FIFO basis. Okay, because this Finance Act number 2 of 2024 is applicable for full year. They don't say no, this is only applicable from. So it should be only on FIFO basis. So that is my understanding. I understand correctly. So another first half is 1,25,000 கழிச்சு balance 25,000 க்கு 10% போடுவேன். இங்க இருக்கிற 1.5 lakhs க்கு full product. இது my view and I will also. So this is an interesting. So those who are on the, if my gain is 1 crore or 50 lakhs, in guides and ஏதோ மேடம் எஃபெக்ட் கொடுத்துருவோம். பட் when I see that the விளிம்புல இருக்கு, so that is where you like this interesting. And people are now planning. See, in a family, as per this stock exchange guidelines and all and rules, one can have more than one demat account also. Okay. Family member demat account. Now we have this private limited company also coming under the demat concept. So almost everyone will come into that bracket, and so far nobody income tax declare பண்ணாதவங்க private limited company shares open பண்ணோம், which will not be there in the balance sheet, no declaration will have been there. Connected to that, what is this, how the source came, investment, so many things will open. So this whatever the amendment that has been brought in Companies Act, you can also see the impact of that having a further amendment with respect to the income related in the years coming years. So this is one more important change there. And maybe with the last one point I will I wish to also celebrate your festival with your family. I take one the last one. This is one. This is one aspect which will apply to unlisted company shares also, because this word property, where the capital asset became the property of the assessee. In the property means never come to a conclusion, it is only immovable property. Now, because property definition is it says that it includes shares, stock and shares element. So this concept is applicable even for financial assets. So especially when the investment is done in an unlisted company, private limited company, this concept will come. Where the capital asset became the property of the assessee before 1st day of April 2001. That means maybe by inheritance. Okay. So then I am selling the shares today to somebody. So then technically I have got only inherited, but then what is the deduction I will get? The deduction will be at the option of the assessee, the fair market value as of 1st April 2001. Immovable property means I will take the stamp duty value in the required. This is only for immovable property. So fair market value in the case of capital asset referred to in 1 and 2 being land and building or both. 1 and 2 in the zone of 1 and 2 land. If it is land and building only, stamp duty value. Otherwise, the fair market value, how do you calculate we have rule number 11 UA of the income tax rule, which says if it is a company share, you have to go by the net worth. Add all the assets minus liability, what is the net worth. If land and building is there, you have to take the stamp duty value, that then add it, then subtract the liability, you will get the fair market value. So, quite a interesting provision. So, this section is also applicable for financial instruments. But in the way rider is given here in proviso, which says that in case if it is a land and building or both, then the fair market value is stamp. It cannot exceed stamp duty value. If the fair market value is below stamp duty value, I agree. And capital gain jasty aagum. If fair market value is more than stamp duty value, I will not agree. The stamp duty value will be the same. So this is one proviso applicable only for land and building. But the option is applicable for. This is the point I want to bring it before you. This is the maximum coverage I could make with respect to the change that has been brought up. But with respect to maybe case studies, will give more insights and more grip on the subject. But I'm sure all are seasoned and experienced to try on your own with this limited coverage what I have done. So, wish to get your feedbacks and reflections. I'll request one of the senior member, Dr. GOPAL, very silently has been watching me. I thought I
Basically, I came after seeing Mr. JKR's name. We are good friends for decades. We chat the workshops on several occasions. It has been wonderful watching him wherever it is on whatever topic. That was the only reason. Even if it is any other topic also, I would have come. He who had attracted me, and from start to finish, to the point, all appropriate points being nicely covered. So you can do maximum justice to this topic only to this extent, I believe, which is done. So thank you for sharing your wisdom. And he has been sharing his wisdom not only on this topic, on several topics, hundreds of topics. All professional colleagues in all the three institutes. I am also a member of all the three institutes. I am also a faculty like him for ISB, IIMs. So it has been pleasure watching such colleagues. So thank you so much for your wisdom and keep continuing it.
Sure.
I really enjoyed. Thoroughly I enjoyed. All the best and happy Diwali to all of you.
Thank you.